Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Monday, February 23, 2026. The market tried to lean into a so-called rule of law rally and then traded like it was staring down a relentless trade war. Relief from Friday's Supreme Court win for importers? It didn't stick. The White House fired back, hiked global levies to 15%, and the tape flipped straight into risk-off. Defensives got bid, energy caught a safety trade, and big tech, banks, and software took the hit. This session wasn't subtle, money moved straight into the bunker. On the S&P 500 Heatmap, it looked more like a rotation map, mixed, choppy, but tilting defensive green. You had bright green islands in staples, healthcare, utilities, and energy, and big red clusters in tech, communication services, and financials. Even inside Megacap, leadership didn't hold together. A couple names stayed green, but most of the complex leaned risk off. No clean index masking today, just traders hunting for selective hiding places. That heat map basically told you where the money went. Traders sold duration-sensitive growth, and anything tied to credit or transaction volumes. Financials got hit. Software and infrastructure linked to the AI profit cycle debate got hit too. And the bids showed up in the simplest places. Earnings stable defensives, staples and utilities, plus healthcare, plus energy as an uncertainty hedge. Even small caps bled with the risk appetite. This was capital trying to get more tangible. Underneath all of this, two stories were colliding. First, policy uncertainty, tariffs, turning a cautious market into a liquidation. Second, the AI trade getting more Darwinian. The tape wasn't saying AI is over. It was saying only the infrastructure winners get the benefit of the doubt, while software-like cash flows get repriced. And the key feel today? No clean buy the dip. It stayed defensive right into the close. One piece of market chatter really caught fire. Desks pointed to a widely circulated Citrini Research weekend note. The angle, AI disruption pressure on legacy software and cybersecurity moats, and that idea may have added fuel to the selling. Separately, the editorial lens focused on a so-called software apocalypse, tied to talk of an AI-native code-scanning tool from Anthropic that spooked sentiment in the group. Discipline matters here. This is chatter and narrative pressure, not a single confirmed explanation for every downtick, but it clearly shaped how traders talked about the move. What if the AI boom keeps winning? And that's exactly the problem. Markets were rattled Monday after a provocative Citrini Research note went viral. The Dow dropped more than 800 points at midday, the Nasdaq slid, and software names like AppLovin, Asana, DocuSign, and Zscaler got hit hard. But this wasn't the usual AI bubble argument about infrastructure or frothy valuations. Citrini assumes the AI boom continues, just not in a way that helps the broader economy. In their 2028 look-back scenario, AI keeps driving white-collar layoffs. Productivity rises, margins expand, stocks cheer, but wage growth collapses and consumer spending weakens. By late 2027, they argue entire business models built on human intermediation start to disintegrate. Housing in expensive metro areas softens as displaced workers lose buying power. Mortgage stress spreads. The warning: markets and the real economy are not the same thing. If the S&P 500 turns into one big leveraged bet on white-collar productivity, and that productivity erodes the income base that supports demand, the feedback loop eventually snaps. In Citrini's scenario, that snap is a 38% market drawdown. The message isn't panic. It's positioning, because when productivity gains outrun wage growth for too long, the bill eventually comes due. Microsoft, MSFT, was the clean tell in the Megacap complex, down just over 3%. The read from the supplied analysis, valuation, and CapEx skepticism around hyperscaler, AI spending, and payback timelines, landing on a day when the tape wanted to de-risk. When a bellwether like Microsoft is down more than 3% in a macro-driven sell-off, it tells you the mood. Liquidity wanted out, not so-called quality growth. Nvidia was one of the standouts, up just under 1%, even as the broader tape sold off. The driver in the supplied analysis, a resilient AI demand story, plus partnerships and initiatives pushing GPU-driven AI into industrial and operational technology security. On a day like this, green prints matter. It reinforced today's red. The market is narrowing to perceived AI infrastructure winners, while it punishes second derivative AI exposures. Apple finished up about 0.6%, and it mattered because the market clearly didn't treat tech as one single block. The catalyst in the supplied analysis was straightforward: relative safe haven flow inside Megacap tech, as investors favored lower perceived AI capex risk. So even with a risk-off tape, there was still a hierarchy. Money hunted for the least controversial balance sheet inside the complex. Amazon dropped about 2.3%. In the inputs, the story was simple: consumer discretionary exposure plus megacap risk trimming on tariff uncertainty. It's a useful read on the day's character. This wasn't just a narrow software wobble when Amazon is read alongside the broader growth complex. It looks like traders cutting beta. Palantir, PLTR, slid just over 3%, a clean read-through on high beta AI and software sentiment. The supplied explanation: investors punished perceived AI losers and de-risked growth, and that matched the broader tape. Keep the benefit of the doubt with infrastructure winners, but reprice software-adjacent risk aggressively whenever macro uncertainty spikes. Exxon Mobil, XOM, rallied more than 2%, and that was the classic risk-off tell. The driver in the supplied analysis: rotation into energy and hedging against inflation and tariff uncertainty. When energy leads while equities are selling off, it reinforces what today looked like from the top down: investors buying real asset exposure as policy risk rises. Near term, the first catalyst is still the obvious one: tariff headlines. Follow-up statements, exemptions, retaliation talk, any of it can move the tape. Second, watch whether the AI winners versus losers repricing keeps tightening, especially in software and cybersecurity versus infrastructure leaders. And on the calendar, next week, the week of March 2nd, brings ISM Manufacturing ADP ISM Services, weekly claims, and the February jobs report. No forecasts here, just the setup. The market is trading brittle and it's reacting fast to headlines. The clean wrap today: defensives weren't a sideshow. They were the story. Megacap leadership fractured, software and financials got hit, and the market treated tariff uncertainty as a reason to cut exposure, not to bargain hunt. Into the next session, keep it simple. Watch breadth. Watch whether the bunker trade expands or fades, and watch if leadership narrows even further or finally starts to heal. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.